Joining us right now is the Vice Chairman of Global Wealth and Investment Management and the head of the Investment Solutions Group at Merrill Lynch and U.S. Trust. Keith Banks is here. Keith, it's good to see you this morning. Thanks so much for joining us. So what's your take on markets here? You're not buying into this whole idea that growth falls off all that much.
No, we buy into the view that you go from probably 3%-ish this year down to maybe 2.5%. But the implication is you can maintain trend-like growth next year. I think what's got people really worried is when the yield curve inverted between 2 and 5 and 3 and 5. In people's minds, the risk of a recession next year went up dramatically. What we think is less that than the yield curve telling the Fed you're closer to neutral than not. And so you can slow down on the rate hikes, given the fact that inflation has rolled over and there's a lot of, lot still flowing through the economy from the rate hikes and the balance sheet unwind.
So have the rate hike expectations changed in your view? Do you still think the Fed raises next year and next week?
Well, I think next week is probably 50-50. And I think if they raise, that's okay. What people will pay attention to is what are the comments? And the comments are dovish. Then I think people say, hey, we're probably getting closer to the end. If they're not so dovish, then people begin to worry again. But next year, again, 1 or 2 maybe.
So the Fed's talking about being so data-driven next year with the rate hikes. But is that going to create a lot more uncertainty? Now people are going to be trying to read the tea leaves. There's not as much forward guidance. Do you see that creating more volatility next year because the Fed takes that route?
Well, look, I think we're going to see more volatility, period. We went from a period of low growth, low inflation, low interest rates, low volatility. We've had a secular shift, right? Higher growth, higher rates, higher inflation, higher volatility. Anything with the Fed will add to that. But I think, look, we can all watch the data as well. And I think the inflation, wage inflation, general inflation, and economic growth will tell us where they're going.
Okay, so your relatively bullish take is about the strong U.S. consumer, or it's also about corporate investment? Where do you see growth coming from going forward?
We see both. I mean, the consumer is in great shape. Right now, you've got an unemployment rate that's rock bottom. We think, if anything, it drifts a little bit lower. Wages are finally going up. That's a good thing. So wage growth is now over 3%. We think that can move to maybe 3.5% next year. Consumer confidence is high, as it should be. Business confidence is high. We think you're going to see capital spending increases next year around 7%. And that's really important because one of the things we need to see, and hopefully through this increased CapEx, is productivity rising, because that can offset wage gains and not put pressure on companies to raise prices. So it's another very important, talk about data points to watch.
How do you feel about the President of the United States, and particularly people in his administration? Peter Navarro was just on with Maria, and he was essentially giving market advice repeatedly. He said that the next leg, if the Fed, he was talking about the next leg up in the bull market, about the Federal Reserve. Investors, what investors should and shouldn't do. They shouldn't get hung up on China. This is a very different communication out of a White House. We're not really used to that. What do you say about it? Does it matter?
Well, look, everyone's got a point of view about what's going to happen in the markets and what people should or should not focus on. The market will figure out what it should focus on. Investors will figure out.
Well, that's my point.
Yeah, and so, it's all interesting. It's all part of a big mosaic of information and viewpoints, of which there is no shortage.
Are you worried about China?
China is important. I mean, one of the things I worry about with the tariffs, if we don't get a reasonable resolution, obviously, that's going to be a negative for the markets. But also, that, I think, could potentially tip over business confidence and perhaps even consumer confidence. And it's going to clearly have an impact on global growth. You look at the EU, which right now is struggling. The EU gets a 45% of their GDP comes from global trade. And so if we do see more slowdown, that's a negative for the EU. So it all matters. It all fits into a broader picture. So
it sounds like you're still buying stocks, Keith.
We are. Look, I think it's a good time to have some powder dry. We don't know where the bottom is. Maybe we hit it. Maybe we didn't. But again, Maria, we think if you believe what we believe, that the economy will grow next year around trend or perhaps higher, you'll get 5 to 6% earnings growth from that. We don't think multiples will expand because of where we are in the cycle. But 5 to 6% lift in the market next year, plus 2%-ish yield, that's a pretty good return given how many years of good returns we've had. So we would take that.
I like what you said about capital spending. That's important. It's good to see you, Keith.
Always good to be here.
Thanks so much for joining us. Keith Banks.